Okay, folks, let's get started. Welcome to the Audit Committee. Very important agenda today, the financial statements of the City of London. Good stuff. I'll look to members for any disclosures of pecuniary interest. Seeing none, we'll turn to item number 2, which is the audit, and we'll start with our treasurer, Annalisa Barbone. We're going to go easy on Annalisa. This is her maiden voyage as treasurer, right?
My maiden and my last voyage, as I look forward to filling this position and introducing whoever will be doing this next year for you. So on that note, what I want to do is just, today we're very pleased to present our annual report and 2016 consolidated financial statements to the Audit Committee. You'll notice that there's a bit of a different look and feel to it this year. We've tried to modernize it a little bit. I want to thank, a huge thanks to all of my entire financial services team who has spent a lot of hours trying to pull all this together. One of the things we find is that although we bring our financial statements to you now, there's all months and months of effort and consolidated work that goes into bringing this, and ultimately all of our boards and commissions as well, who all pass their financial statements so that we can consolidate them for all of you today. So I think we're excited to bring this forward. We also want to thank our external auditors and their work and support with us to ensure that these are delivered on time and are able to meet our timelines to bring everything to you today. So on that note, I'm just going to refer to my notes here. We've included in your binder, in past years where we've had various sections, we now have kind of consolidated what is going to be our, going forward, more of our future annual report type for our consolidated financial statements under the first tab, which is the Treasurer's Letter and Financial Highlights. And then we've still put a separate tab so you can easily find that 5-year review to give that quick high-level summary of the 5 years, kind of that pattern of our expenses and revenues and some of the indicators. And then the tab with our consolidated financial report, which is all of the boards and commissions consolidated together for you under the City of London's financial performance. So giving you just a little bit of background, just to kind of run through this really quick to remind you in terms of what it is that the City of London has actually implemented in our PSAB changes. Since 2009 is when we implemented the really significant tangible capital assets that we've reported to you every year since. So that was obviously a very, very significant change that came forward. And then moving forward, we've kind of continued on with the government transfers, and tax revenue, which took effect in 2013. Not a significant amount of change with respect to our financial statements, but last year, for the very first time, we implemented the liability for contaminated sites. So although last year did not result in a liability that we did bring forward, what you will see is this year, as we went through the very same process and started to go through, to remind you again, the liability is recorded when we have an environmental standard that exists. All the sites are based on sites that are non-productive in nature and where contamination does exceed the standard. And of course, you have to be able to reasonably estimate what that liability is going to be. This year, or 2016, our financial statements, we actually did find a property that met that criteria. And when you go to note 23, you realize that we had estimated the cost to remediate at $1.3 million, and that has been booked and is recorded as a liability and an expenditure in our City of London financial statements. So one of the other things that we did go forward was KPMG, through their audit procedures, did identify another site that it did meet all of that same criteria. The liability was not significant and then the amount was not material, so it did not get recorded. But as part of that process, we've effectively improved our process to look at, as we purchase new sites, to be able to work with Realty to implement a new process to start looking at, as we identify new sites or purchase new sites, whether they require remediation, so that we can book that at the same time so that it doesn't get missed going forward. So just to run you through quickly again what the purpose of our financial statements, our consolidated statement of financial position, which basically highlights for you the summary of all our financial assets and liabilities and gives you a good sense of what our liquidity is for the future. Our statement of operations, which walks you through all our revenues and expenses to show you the net surplus at the end of the year. Our statement of changes in net assets will give you basically this high-level summary of what our tangible capital assets and our annual operations all result and basically the changes in all of how those balances have accumulated, and then looking at our statement of cash flows, which shows you all the sources and the uses of cash. So running through the statements, just to give you a quick walkthrough, if we start off with our statement of financial position, page 27 in your binder, I can just go over some of the quick highlights for you. So in 2016, overall, our city's net financial position actually increased to $235 million, and essentially a $38 million improvement over 2015, which basically shows you that we have strong liquidity, we can pay all of our liabilities and our future expenses because our assets are higher than what our liabilities are going to be. As you look through the changes, one of the key changes that you look at, there hasn't been a lot of change, but you can definitely see our investment in government business enterprises has strengthened, and primarily as a result of London Hydro, we see $1 million worth of growth that is being recorded there. As you look down, going through some changes in our financial liabilities, they have increased $45 million. You see accounts payable, accrued liabilities have gone up $26 million over the previous year. That is specifically as a result, our $1.3 million contaminated sites liability is part of that. We also have all of our liabilities and amounts for personnel agreements are all included as that, as well as some increases in our holdbacks and basically timing over the growth in our expenditures, having them paid over the previous year. When you look at deferred revenue, you see there's quite a significant increase of $51 million, which is specifically as a result of our obligatory reserve funds, which when you look at note 7, I believe, on page 45, you'll see that a large part of that is approximately, most of that $50 million is development charges, which has been collected and placed into our obligatory reserve fund as per the Development Charges Act. And then again, all of those increases have been offset by a decrease in our long-term debt overall of $21 million. So they all offset each other. Looking forward to our non-financial assets, you'll see just a reminder that our land, which is held for resale, specifically industrial land is a good example, is shown as part of our financial assets. Our tangible capital assets are not liquid or readily available for sale, which is why they're shown below the line, and essentially gives more of the emphasis towards our net financial asset position of the municipality. You will see that our tangible capital assets, or TCAs we refer to them, has risen by $127 million, which is basically a result of the city's ongoing investment in continued investment in the city's infrastructure. You will see that our accumulated surplus has gone up by a total of $166 million, which essentially is the net $38 million of our net assets have gone forward, as well as the $127 million which has been invested in our TCA. So just speaking of TCA, just to give you a quick sense, this is in our note 14 on page 53, just a highlight again of our tangible capital assets. So you can see based on her historical cost, focusing with our depreciation to show you what the net book value of $3.6 million is. So translating that in terms of, although we have that showing on our historical cost, the replacement cost for that infrastructure is closer to $11.8 million, which is based on a lot of inflationary factors over the year. So tying this into our State of the Infrastructure report, as you look back on 2013, and as we look at trying to update those numbers, basically our infrastructure deficit is continued to forecast to be over $400 million in the next 10 years, which is another strategy that we're trying to move towards investing and trying to close that gap. Taking you through our high-level statement of operations, just focusing in on revenue. Page 28 is our consolidated statement of operations. Overall, you'll see that we have 2016 revenues are up $32 million, which is 2.8% over the previous year. There's increases in both taxation revenue as well as user fee charges of about $35 million. Significant component is also government transfers, which is primarily increased as a result of our additional funding for social assistance, our homelessness portfolio, as well as childcare services. And one of the other key items that you'll note is that we do have developer contributions recorded of $37 million. Although that is slightly over 2015, this is predominantly for assumed subdivisions, which again is one of those things that is not recorded as part of the budgeting process that you'll see further on when we look at some of the differences between PSAB and our budget. So when we look at expenditures, you will note that we've also had an increase in expenditures, which is about a 1% increase of $10 million over 2016. Most of the functional areas do have slight decreases over the prior year. However, the largest single change that you will note is in social and family services of $8.1 million, which again is related to the increase in provincial funding for social assistance as well as childcare. Planning and development has also increased slightly has increased over $6.5 million over the previous year, which this is part of where you see the $1.3 million for our contaminated sites liability is included in this amount, as well as some additional cost of goods sold for our industrial land, and all of our land held for resale goes through this area as well. So just going through in terms of a reminder again that the amortization is included in all of those various components. Our debt principal repayments are not expensed, and all of our contributions to reserve funds that you do through the budget are also not expensed. So taking you back again to, we've shown this for a number of years just to kind of remind you between the difference between PSAB versus the city budget. So to kind of highlight, again, the developer contributions are recognized. You don't do that through the budget process. The operating expenses are pretty much simple, although the capital expenses where you do account for that through a cash flow basis on your budget is not shown in the PSAB, and those are all primarily your tangible capital assets that get recorded. So you can see those key differences, but we do show the amortization on the one hand. So you can see the difference between your annual surplus that we try to get to for the city budget is zero versus where you would have potentially a surplus in your financial statements. So walking you through the translation of that in terms of this is what our city dollars are, you can see the differences in the revenue between what you would have seen approving the city budget versus what we would have done under our PSAB accounting. So you'll see that our revenues are significantly higher versus the city budget because of the capital funding, our developer contributions, the revenue through the reserve funds, and the changes in the boards and commission surplus and government business enterprises. So on the expenses, you'll see very similar changes as well. Our debt principal repayments, the transfers to reserves, our capital expenses are not there, but what you see in its place is the capital expenses that we do not capitalize, so things like planning studies or things that might not be regarded as an actual asset, but you see our amortization is recorded instead, and definitely we have a loss on disposal of capital assets that gets recorded. And what you'll see is the change in the liability for landfill, contaminated sites, and employee future benefits. It is showing as a negative in this regard simply because we did have our liability actually decreased primarily for some of the employee future benefits over the previous year, which is why it's offset the opposite direction. Another quick way just to kind of look at this quickly in terms of looking at going from our surplus that we're showing of $166 million through to zero. This is just a different way of showing the exact same thing to kind of help you understand what the differences are. So that in a nutshell is our financial statements. What I wanted to touch on quickly as well is our internal controls. This year, KPMG did some outstanding work in identifying a couple of things on in their audit control findings that they will be presenting to you next. And what they did identify was that there's a couple of areas where our internal controls can be strengthened. There are some processes that are within finance's control and some that are outside that we will be working with those areas to try to address. And certainly things with respect to cutoff and things that are very specific to our financial internal controls will be things that we have implemented new processes to look at, better training, and really trying to focus on year end to ensure that we have a much cleaner cutoff and working with the staff in making sure that this is strengthened as we go forward. And certainly as we've now got an approved internal audit plan that will be going forward. Some of those areas are actually already identified within their next four-year audit plan. So it'll be working with them and providing those recommendations to them to help us move forward and try to close those gaps so that they're not coming forward again next year, and essentially look for some of their recommendations to be able to move forward in closing and identifying some of those things. So some things we've already done through process, but some broader things may need to be looked at and potentially could be done a number of ways that hopefully they will be able to assist us in moving that forward. So just to highlight again, there are some other significant changes coming in our public sector service standards going forward. The more recent ones coming will be further enhancement on related party disclosures as well as our inter-entity transactions. Those will be in the next couple of years. After that, the really larger one, I guess much more larger ones with larger impact to the financial statements will be the financial instruments as well as the foreign currency translation. So we're working on those now and trying to put some things in place so that we can make that transition very seamless to implement all of these. So moving forward, I think obviously whether you have questions now or if you want to wait for KPMG to present their audit findings, I'm in your hands. But that is it for my presentation.
Okay. Unless the committee feels differently, I thought it might be good just to have KPMG continue on and present their findings, and then we can Q&A it, unless there was something specific for Annalisa at this point. Okay. Come on ahead, Katie and Ian.
There we go. All right. Thank you very much for having us here today. For any of you who do not know me, my name is Katie Denbach. I am the engagement partner on the City of London Audit, and I have with me here today Melissa Redden, who is the senior manager on the engagement, as well as Ian Jeffries, who is sitting in the cheap seats in the back. So we're here today to walk you through our audit findings report. Annalisa mentioned a couple of things specifically that we'll address, and we'll also go over the standard results of our audit that we are required to discuss with the audit committee. So I will start on page 3, if you look at the top right-hand page numbers on our report with the executive summary. So just a reminder to the committee that the purpose of this report is really to assist you in your evaluation of the results of our audit of the consolidated financial statements for the city, and it builds on the audit plan that we presented to this committee back in February. There's been no changes to the audit plan that we presented in February. We were able to perform all procedures as planned in our audit plan. In terms of audit risks and results, there were a couple that we brought forward to the committee as being standard risks, which include the presumed risk of management override of controls, as well as the completeness of accruals. And we'll report back to the committee that we performed the procedures as planned in those areas, and there are no specific findings to report back. Adjustments and differences, we do have one uncorrected audit misstatement to report to the committee, which Melissa will get into more detail on a bit further on. On page 4, finalizing the audit. So obviously this report was prepared as of June 2nd. So since then, there's been a few items that we were able to knock off this list. So happy to report that item 1, what we require, we have a couple of legal confirmations still outstanding, as well as an update to them to be done closer to the date of our audit report. The next 3 bullet points have been completed, so those can be struck off the list. And the remainder of the outstanding items really just include obtaining the management representation letter once the financial statements have been approved by council, and completing our discussions with the audit committee here today. So once those things happen in due course, we anticipate being able to issue an unqualified audit opinion. As Annalisa mentioned, we do have some control and other observations to report to the committee, and Melissa will get into those shortly, as well as the results of our audit over critical accounting estimates. We confirmed to the audit committee that we're independent of the city and its related entities, and also that significant accounting policies are consistent with prior year and are appropriate in accordance with public sector accounting standards. Flipping over to page 5, audit risks and results. One of the items we identified in our audit plan as being a significant financial reporting risk is the completeness of accruals, and that's because there's a lot of estimates and assumptions involved in calculating some of the accruals, such as legal accruals and landfill liabilities. So happy to report that we did perform the procedures that we had planned, which I've listed on the page here, and no significant issues were noted as a result of that testing. Other areas of audit focus, really, again, just reporting back to you on what was included in our audit plan. Capital projects and acquisitions, payroll, and employee future benefits, as well as taxation, user charges, and transfer payments revenue were identified as being other areas of focus because they're so quantitatively significant to the financial statements. This is by no means all of the work that we do during the course of our audit, but just the larger chunks of it that we wanted to highlight to the committee. So again, the procedures are listed here for your reference. There are no issues to report with the exception of the control matters with regards to payroll that we'll get into shortly. Just an update for the committee on the other matters that we brought forward in our audit plan in February. The Southwest Community Center joint venture, we have met with management, we've reviewed the agreement and the accounting treatment for this joint venture. And so we did that as part of our audit and no issues were noted as a result of performing those procedures. Ontario Works, this has been an ongoing item that is in the process of being cleared up, but there are still some months that remain unreconciled for which management has booked an estimated accrual in the financial statements. We perform procedures over that and consider those estimates to be appropriate. And with that, I'm going to pass it over to Melissa to walk you through the rest of the report.
So looking at page 9, this is where we've laid out our critical accounting estimates. So we've highlighted both the landfill closure and post-closure liability as well as the accrued liabilities, as this is where there is quite a bit of estimation involved in these areas. So we've laid out the details on this page as well as the next page. And basically the estimates that we've looked at, we consider them to be reasonable, and they're also consistent with what we've seen in prior years. So nothing really significant to report there. Flipping to page 11, we've highlighted the data analytics that were performed as part of our audit procedures. This was laid out in our audit plan. So we performed the routines as we noted that we would, and there were no issues noted as a result of any of the testing that we performed in these areas. Moving on to page 12, we consider the form, arrangement, and content of the financial statements to be adequate and appropriate. We've also laid out the accounting pronouncements that are coming out over the next couple of years. So Annalisa touched on those. So we're not going to go into those in too much detail, but just wanted to note that there are no concerns at this time regarding future implementation. Moving on to the next page, we've laid out the adjustments and differences. And as Katie mentioned, there's only one uncorrected difference that we've noted, and there's nothing that's been identified by us and corrected within the financial statements. So on page 14, we've included a little bit of detail on the one uncorrected misstatement that was noted. This was an out-of-period adjustment to record reserve funds held by a third party. So this was required to bring, although it resulted in an overstatement of other revenue this year, it results in bringing the statement of financial position to correct values as at the end of the current period, so that there won't be anything that's inappropriately recorded going forward. That brings us to our control observations. So we have noted a few control deficiencies to bring to your attention, but nothing that we consider to be a significant deficiency. So looking at page 16, the first item we've noted is during our control testing over payroll, there was one instance where there was a significant time lag between when the employee was terminated and when the payroll department received the termination form. This was in relation to Agency 3, and as a result, this employee was paid nominal amounts for a stat holiday that they were not entitled to. So we did look into this matter more. We note that the total payroll for Agency 3 is not considered to be significant to the financial statements, but we do recommend that there is a process implemented whereby all terminations are forwarded to the payroll department in a timely manner, and that managers review any pay subsequent to termination to ensure that all pay is appropriate. Moving on to our next control item, we noted one instance where an employee was transferred to Agency 9 and they accrued vacation in excess of their annual entitlement. So during our testing, we did note that this risk was limited to employees transferring to Agency 9 and not transferring to other agencies. As a result of this, management did some additional review over the vacation accrual calculations, which they did identify some additional errors. However, the value of those errors was below our audit misstatement posting threshold. So there has been no audit adjustment related to this error, but we did want to bring it up and recommend that management implement review procedures to ensure that vacation accrual dates are appropriately updated in the system. The last item on this page is another instance relating to payroll where we've noted an employee possessed signing authority to approve their own electronic timesheet. So we performed testing over compensating controls and noted that those were operating effectively. But again, we would just recommend that on a go-forward basis, there are controls in place to ensure that timesheets are subject to the appropriate level of approval. Moving on to the next page. While we were looking at the accrued liabilities, we noted an instance where TCA purchased in fiscal 2017 was recorded in the current year accounts payable. So additional procedures were performed to identify if there were any further errors relating to this. We did note that we did quantify the impact of the misstatements and noted that it was below our audit misstatement posting threshold. So again, there has been no audit adjustment related to this error that was proposed, but we would recommend that management provide some additional training to staff surrounding the recording of accounts payable and accrued liabilities at year end to ensure that the appropriate cutoff, or that there is appropriate cutoff. The last item we've noted here relates to the liability for contaminated sites. As Annalisa mentioned, we did note that there was one instance where there was evidence of contamination, but there was no liability that had been accrued. So we did extend our sample as a result of that, and there were no errors that were noted in the extended sample. This risk was limited only to the liability for contaminated sites, so again, it's not considered to be a significant deficiency. We would recommend that management implement a more collaborative approach to reviewing their land master database and make sure that the appropriate parties are actively involved in review of that master database, as well as recommending automating the process for tracking land inventory to reduce the risk of manual errors. So that brings us to our appendices. So I'm just going to go over these relatively quickly, as these are really just here for some additional information for you. Appendix 1, these are the required communications. So one of those is the auditor's report, which has been attached to the draft financial statements, the management representation letter, which is included in Appendix 3, and the independence letter in Appendix 2. So as mentioned, Appendix 2 includes our independence letter. Appendix 3 is the management representation letter. Appendix 4 provides some additional information on KPMG's audit quality and risk management. Appendix 5 is some additional information on background and professional standards at KPMG. And then Appendix 6, this is a current development, so there is some change coming just in relation to asset management, so we did include some additional information on that as well. So that concludes our audit findings report, and we'd be happy to take any questions.
Okay, thank you very much. I'll look to committee for questions. Let's do questions first before we do commentaries. So any questions? Okay, Councillor Hopkins.
Yes, thank you, Mr. Chair, and thank you for the report. I was just curious to know, I understand that you are going to be, you suggested reviews and procedures and controls and staff training and automation in tracking as well. How do you, will these review procedures be done right away, or what is the process, sort of, when will they be implemented?
Annalisa.
Thank you, through the chair. So some of them are things that we have already done. The automation process specifically with respect to land is actually one that we've been working on since February. So we currently do not have a database that we have for land with respect to the accounting portion of it, and how we do all of this is a manual done through Excel. So we've been, now that we have a system actually that was purchased through our capital asset management team, we're working to move towards all of our inventories and are moving. So land has been flagged as one of the ones that are actually first in our list to try to transition over, so that we can specifically close this gap and be able to track some of the things that are coming, as well as what we currently need to do. So the things with respect to training with cutoff, those ones, we are working on that process. At the end of the year, we have targeted those because we will need them in place for when we train all our staff in December to be able to look at. So there's varied timing throughout the process, and all of them we're hitting as the priorities need to ensure that they're addressed all by January 1 of next year and moving forward. So some of the ones that are a little bit broader beyond our areas may take a little bit longer as we coordinate all the parties, but certainly the ones within finance are well underway right now, and with the target date of having them done by the end of the year.
Councillor Turner.
Thank you, Mr. Chair. Quickly to Ms. Van Buck. For the purpose of the audit, what did you consider materiality?
Yeah, so our materiality level remains unchanged from our planning report, and sorry, I wrote it down here, just bear with me for a second. I believe our materiality level was $15.1 million. That's based on a benchmark of total expenses. And our audit misstatement posting threshold, which is the level at which we would report any corrected or uncorrected audit misstatements, was $770,000.
I have a question with respect to page 17, the trade payables and accrued liabilities. Just with the control deficiency that was presented, it discusses the one instance for the TCA purchased, and then there was additional procedures where there were further errors. And I'm just curious as to the process there. Would that also include expenses? Because I would assume you'd have an invoice. The invoice would get, has a date associated with it, and that's maybe where this error had occurred. So I think I was just hoping for some more color on what happened there and why expenses maybe aren't being, if there was any cutoff issues with expenses in addition.
So when we were taking a look at this, this was an item that came up where we did consider both whether there was anything that was recorded that would have been capital in nature, as well as if there were any expenses. So management actually went through all of their accruals at year end above a certain dollar threshold, and just rechecked all of them to ensure that there wasn't anything else, either expense or capital related, that was unrecorded, or sorry, recorded in the incorrect period.
Okay. Any further questions? Councillor Turner.
Thank you. From Ms. Barbone, I guess. There's a couple here. In your report on on slide 9, statement of operations revenues, talked about developer contributions of TCAs having about a 10% decrease, I guess, over year previous. So it's from total 37.5 million, decrease of 3.7 million, predominantly is for assumed subdivisions. I guess the rationale for that is that potentially from a shift in development patterns in the city, where I guess what I'm looking for here is wondering if this is growth within the growth bound, or within the growth footprint of the city, or greenfield growth where you'd see new infrastructure placed, and hence you'd see more asset turnover, versus if you're building apartment towers in the built growth area, and you wouldn't necessarily see that transfer because you'd be tying into existing resources.
Through the chair. So this, some of it is with respect to timing, I think, and how the true, when they become assumed and when they become an actual recognized within, so some of it's timing and when it actually gets recognized over previous years. So it's a bit of a more difficult, but this is truly, there's some offsetting, there's some pieces that get recognized versus there's a netting out to some degree in terms of what's actually recognized in our statements. So it's not as simple to be able to identify a pattern per se, because some of it is a lot of the timing of when the revenues are coming in and when they're actually flowing out to record them as an expenditure versus, so there's some ins and outs that are happening as well. So this is kind of the end result in terms of where that is. So it's really a lot of the timing with respect to the inflows and the outflows and how that gets recorded as a revenue figure that we take the net figure in our financial statements.
Fair enough. So from year to year, it's going to be hyper variable. Is there kind of a margin within the mean that they would expect it? I mean, would you expect to see fluctuations of 20 or 30% from year to year sometimes, or does it stay fairly tight?
Through the chair, I think in past years, you tended to see a little, because there's been a lot more activity. I think the last couple of years, we've seen a lot more variability in it than we would. And I think this year, certainly, I would expect that in 2017, we potentially might see some quite variability again coming, just because of the nature of there's a lot going on in that area.
And ultimately, through the chair, that wouldn't necessarily have much impact on our operations and our ability to this is more an accounting of where those TCAs land. So it's fairly not material to impact on us. It's just a question of how we're accounting for it. Okay, appreciate that. Thank you.
Thank you. I wonder if either our auditors or our staff could speak about the upcoming changes for the related party transactions. I think one time when you read through the consolidated financial statements, you really get a sense of how many related parties we have at the City of London and the various different kinds of agreements and arrangements we have around revenue and expenses and, collection of billings for water by hydro and, joint ventures, all kinds of related party transactions. And I just wonder, I know that it says that there's no anticipated issues with implementation of that new standard, but I wonder if we could just start talking about it now and sort of what it might mean in terms of the financial statements and how our financial position is represented in those statements. Because really this is the last year we've got before it's going to be effective. It's going to be effective as of the end of 2018, right? So I wonder if our staff or perhaps the auditors could speak to it.
Through the chair, I'll start and then we'll see if they would like to add. I think one of the key there are two standards that are currently in place right now that will be repealed as a result of that going forward with the new changes. So there is a transitional timing with respect to that implementation that might buy us an extra year in terms of implementation, that it would likely not be shown until 2019's financial statements, just because of that. We're currently following them right now. So what you will see is a lot more disclosure of what those related party transactions would be. So not necessarily a change in how they're recorded, but it's very much disclosure and very much identifying what those related parties are and ensuring that all of that activity is very clearly highlighted and outlined in terms of transparency in your financial statement. So I think that's one of the most significant changes you will see. A lot of it is, there's a great deal of it that we're already doing. This would go one step further to record in the city's note a little bit more detail of what those specific transactions are that go a little bit beyond what we are. I think if maybe KPMG wants to speak to the specifics of it.
Sure, yeah, just to add on to what Annalisa said, it's correct, it is largely a disclosure requirement and a requirement to identify entities that may not previously had been considered related parties using certain criteria such as who has control over the entities to determine whether there are any related parties out there that may not be currently disclosed. One thing to remember with these financial statements, because they are consolidated financial statements, all of the boards and commissions that get consolidated into the statements, any related or inter-entity transactions are eliminated. So when you look at it on a consolidated basis, those aren't, for this purpose, considered to be related parties because they're included right within those consolidated statements. So I would anticipate that a change would be more related to not a board or commission, but another party that the city might transact with at a non-arm's length manner.
Okay. Okay, Mr. Kumar?
Just on a similar line, for the anticipated accounting pronouncements coming, is there one that we should keep our eye on? Is there one that's sort of larger than the rest that could cause our friends at the city some stress at night?
Of the ones that are listed on the slide here, I would say financial instruments is probably the one that has the most potential of these ones listed to have a larger impact on the financial statements, because it will require sort of fair market value accounting for certain types of investments, which I know you're familiar with. The other thing that isn't listed on this slide, because there's no date for it yet, is a standard with respect to asset retirement obligations. And that is expected to require a lot of work, similar to liability for contaminated sites, on the part of management to really go through procedures to make sure that any retirement obligations associated with current assets have been reflected as a liability. So that one, there has not been a date set for implementation. It's still in a discussion period, I believe. So so it's not on the slide, but I would say that would be one to keep your eye to. And we most certainly, as information comes available, will be passing it along to management and to this committee through our audit plan and audit findings report in the coming year.
Okay, anything else? Okay, Councillor Turner?
Thank you. A quick one for Ms. Barbone. Just with respect to the statement of financial position, I think the current assets are probably the cash and equivalents plus accounts receivable. And then the current liabilities would be accounts payable and accrued liabilities, plus deferred revenue. Would there be other ones that would be included in that? So what I'm looking at there is the current ratios, which from 15 to 16 we saw a flip in our position where we had a net positive and to a net negative on the ratio. I think you talked about references to note 7, which is mostly a question of those development charge holdings themselves as liabilities, but we also saw a decrease in our cash on hand position as well. Are there any concerns in flipping from both of them are pretty tight, I think, in terms of ratio, so it's not a huge switch, but it does go from positive to negative in that ratio. So any commentary on that?
Go ahead,
Thank you.
Annalise.
Through the chair, I think one of the key things that it's more moving towards a little bit of a longer term position. And I think when you look at our investments, which is note 4, you'll see a very significant increase in the investments. So you're moving a little bit more into the longer term strategy. And I think tomorrow when you look at our CSC report on our investment report, you'll get a sense of how we've been trying to lengthen that position. So some of that cash on hand has decreased, particularly because we've been investing more for the long term. So I think some of that as you start to look at, and we've been managing that, some of that is the increase. So we don't see any significant concerns now. We've been managing that on a pretty regular basis to keep an eye on that, to ensure that we've got enough cash on hand to meet our objectives on a short term, as well as looking at the longer term to see where we can possibly try to increase our returns by holding a little bit longer term and by managing our cash flow appropriately.
Thank you. So that is ultimately what I was looking at. Are we comfortable in meeting our current liabilities with our current position? So that's helpful. Thank you.
Cash is king. Okay, any other questions? Councillor Helmer.
Thank you. At various points in the financial statements, discount rate is used to the present value of some future series of cash flows. Is the same discount rate used across all of the entities that are reporting and consolidated in the financial statements? It looks like this year it's 3.5%, and is it uniformly used across all the different entities?
Through the chair, I'll start. So when we do that valuation to pick a discount rate, generally on a 3-year basis when we go to do our post-employment benefits review. we look at what our debt issuances are and try to mirror the term to come up with a discount rate that's appropriate. So yes, when we come up with a discount rate, we very closely look at what that is and we communicate that to our boards and commissions to ensure that we're all using a very similar valuation. And that report is we do that on behalf of the LTC as well as the library, and we do use that consistent. I know we've connected with the health unit as well to try to ensure that we're all trying to ensure consistency and then look at that upon consolidation as well.
Okay. I'm still doing questions, so go ahead, Councillor Turner.
We're having fun. That's right, Mr. Chair. Again, to Ms. Barbone, I think you make note of this in page 20 of the binder, which is specific to reserve and reserve funds. Over the past 5 years, a fairly significant increase in total holdings in reserve funds as a net amount. Reserves themselves have been fairly stable, but seen a significant growth in the reserve funds. Those are obligated funds. We don't have much choice in them. And you do make note in there saying that it does not include the effect of budgeted commitments on that. But we're, in terms of our contributions into those reserve funds, are we contributing at the right level, or are we over contributing? And I imagine we certainly have plans to spend that as obligated.
Yes, reserve funds. Annalisa?
Through the chair, thank you. It's a very good question and something that we're actually trying to take a proactive approach to look at. So on first glance, it appears that yes, we're having significant growth in our reserve funds, but a large portion of that is specifically with respect to capital infrastructure, which when you compare it towards what a $400 million infrastructure gap might be, one might say that although they're significant and have been growing, they might not be enough in the long term. So something that we're trying to do and that we've already initiated is to start going through our reserve funds and start to look at targets for what they should be and trying to link that into some potential policy that we can bring forward in terms of actually having a sense of, are we high or low, or are we at the right spot? I would say, although we've been increasing, we can always certainly do much more, particularly with respect to our capital infrastructure, because we know that that gap is something that we're trying to close and that we're working towards. In other areas where you look at our post-retirement benefits, those kind of things, we have a fraction of what we might need, but we're managing that. So all of them are very different and unique, and the ones that are obligatory, that are there for a purpose, and we have to, again, balance by all the regulations. So that is something that we're looking at. I would say, although they're significant, we're not there yet, but we're trying to move towards trying to come up with a bit of a targeted approach, and maybe they might be grouping. We're not sure on how, we haven't worked through that entirely, but certainly looking at how we might approach that. So some of them, with respect to capital infrastructure, might be grouped together to look at targets on how to balance those. But that way, when you look at the increase, to have something to see, to balance that towards, are we there yet, will give a better sense to the reader of the financial statements, whether we're in the right direction or whether we're high, low, or just right.
Thank you. I could see a lot of value to that kind of insight, helping ourselves and our successors during budget time to knowing, what's the risk associated with this, with each of the reserves and reserve funds and our contribution levels, so that we know what we're wading into on a prospective basis. Thank you.
Okay, Councillor Van Holst.
Thank you very much. A great deal of work went into this. There's a lot of information. I appreciate the consistency of it because that made it a much quicker, easier read. The first question I wanted to ask, and I'll ask a couple. You may not have answers off the top of your head, but interesting was the figures about debt per household and discretionary reserves and funds and reserves per household. How do those compare to some other cities in the province, or do we know that?
Through the chair, I do not know off the top of my head how that compares to other municipalities. I'd have to get back to you on that one.
Okay, well, it's encouraging that we've got about, almost twice as much reserves than debt. It looks pretty good to me, and I'm wondering, hey, how we're doing compared to others. I also noticed that quite a number of our boards and commissions ran deficits this year. And I wanted to ask if there was something about 2016 that might have been responsible for that?
Michael, it might be helpful. Could you give us one example that you're particularly focused on?
Okay, by the time I got to the health unit, I noticed that was one, and there were others I'd have to flip through. I just, as I went, I noticed, I noticed a number of them.
Through the chair, I unfortunately can't speak to the health unit specifically, but I'm not aware of any overriding reason that would have been common amongst the boards and commissions. And Annalisa, please correct me if I'm wrong, but that would have caused deficits this year.
Thank you. Searching through things that might be more questions versus comments. I did have one question just about an understanding. It was with the Transit Commission, and it talked about can I find it? Oh yeah, deferred fare media. And although I understand what it is, I'm afraid I don't understand why the word media is in there. Why is that term used? So that was for the transit.
Concept of deferred media, do we know what that is? That's
Deferred
not
fare
tomorrow's-
media.
Oh, fair media.
Deferred fares seem like a reasonable idea. I just don't know why media it was used.
If staff doesn't know, I might look to Councillor Helmer. He may be familiar with that term. Do you know what that is referring to, Councillor Helmer?
This is found on the statement of financial.
I'm just asking
positions.
because you're on the LTC board, not to put you on the spot. It's a concept I don't know what it's referring to. Okay, here's what we'll do. We'll get an answer for the councillor before this comes to council next week.
Yeah, so if you look on page 246 of the package, there's a note, it's note C under significant accounting policies for the Transit Commission. It describes what's recorded under deferred fare media.
Thank you. I understood the description, but the use of the word media seemed, it eluded me, but thank you.
If I can be helpful, we sell all different channels, and there's different ways of selling transit services. Sometimes we have monthly passes, sometimes we have tickets. This is a kind of catch-all thing that says there's different media that we're using. So sometimes it's tickets, sometimes it's cash, sometimes it's a pass. This is a consolidation, the kind of term that catches all of those things.
Okay, thank you very much. So a pass would be a medium and one of a media, okay.
That's really helpful. Thank you. Go ahead, Councillor Hopkins.
Thank you, Mr. Chair. I want to ask staff this question because it's been puzzling me as I've read about our building permits obviously going way, way up and our assessment growth dropping down slightly. And I'm trying to understand when we look at our 5-year plan and our tax rates and seeing industrial and commercial going down, I'm just trying to kind of understand that whole story moving forward. Any concerns on how we will look at our tax rates or or how do we look at our tax rates moving forward? If you could help me just sort of, do you take these figures into account, or how do you process that?
Through the chair, so that I understand, so you're looking specific, so I can make sure I have clarity to answer your question. You're looking specifically at the tax rates in our 5-year plan and comparing them towards our residential, multi-commercial, commercial and industrial, and looking at the trends over time? So when we look at this, obviously, this is including as well as our education rates as well, which are set by the province. So if I think there's a couple of different facets. So one is the tax policy component that council sets, in addition to the budget, which is the increases that taxes also are set. So there's a couple of varying components through how that all works, and certainly based on how much the revenue is required by the municipality through the budget submission on an annual basis, sets what that average tax increase will be across all different forms of the classifications for the taxes. The tax policy sets the ratios then that differentiate between what classifications then pay the larger share of the pie. So they all kind of go together in terms of giving you a sense. So this also includes the education rates as well, which I think if I were to have that other tax policy chart that showed what it was pre-education versus post-education rates, might give you a little bit more clarity, because the education rates skew it quite significantly for some of the classes. So that might be, in terms of when you look at how that all looks, you can totally see that industrial has gone down over 2012, and there's been also residential, you'll see since 2012 has gone down slightly, but virtually consistent to some degree. So I think some of that is the shifts that the tax policy plays in, as well as the overall budget and how that all fits together. Maybe, and certainly having the education is what you actually pay at the end of the day, but does go beyond what just the municipal requirements are. So we could look at breaking that out if that might be useful in the future.
Thank you for clarifying that. I think that education part was what was missing there. And of course, I didn't realize that. So it would be helpful just to have a greater understanding, or what the taxpayer is paying and what we can anticipate. So thanks.
Okay. Commentary? And then I'll look for a motion to receive the reports and approve the financial statements. Okay, I'll take the motion and then we can debate the motion. Okay, so moved by Mr. Cooler, seconded by Councillor Van Hulst. Okay, we'll debate that. So we're receiving and approving the financial statements. Councillor Van Hulst.
Thank you very much. Just maybe a few issues I could bring up now. That would be fine.
Sure. I mean, we're really looking at the consolidated, right? So we don't have staff here from each board and commission. So we're really, if that's correct, we're really looking at the consolidated statement of the city.
Okay. Well, Mr. Chair, your comment may have staved a lot of questions then. So I think many of mine were on some specifics, but I can find those answers out.
And I know that certainly the two boards that I sit on, and I'm sure the ones that other councillors sit on would be happy to have those questions put directly to them. It's a little unfair to ask Ms. Barbone to answer for those boards. It's really the role of the boards of directors of each of those organizations to ensure the veracity and to receive the auditor's report of their particular organization. So our role is really the consolidated statements.
I'm fine.
Thank you. So the presentation here is very helpful. I think the comments that I made previously about reserve fund and reserves themselves, I think that's going to be one of the perpetual issues that council should be addressing as we look at the financials in the city, and especially as we set the budget. So anything that can be done there, and I'm glad to hear that that is something on the work plan to be addressed. So very helpful. One of the things I find very encouraging is taking a look at total debt and seeing that from 2012 to 16, we saw a 10% reduction in our overall debt load. And even just the switch from 15 to 16 was almost 6-7% on its own in 1 year. So it really tells a story of us taking a look at pay-as-you-go financing, the effects of those things, and really having a good solid hold on our financials. I'm very thankful to KPMG as well for your oversight and recommendations. It's really good to hear that in terms of materiality, there's really not a lot there, and the recommendations are supportive in nature and have been acted upon quickly. For this, this gives me a good sense that we maintain the AAA credit rating, that we're in good financial hands, and then that stewardship remains. So that's reassuring, and this is a very helpful process for us to go through. So thank you.
Sorry, I actually missed a question. On page 53, there's a note about tangible capital assets, and under additions, for computers, there's a total of $5.9 million in additions for computers. And I was thinking about that, and I was at a loss sort of what that was. And I wonder if our staff could remind me, because it's on a base of only 9 million, it's a significant increase, in terms of that particular asset class. I wonder if you could just let me know what unusual thing happened to have such a big addition for computers.
Through the chair, I'm trying to recall exactly when we did this, if it was early last year or if it was, I forget the timing, but we brought forward a report where there has been a switch from leasing corporate PCs to now purchasing. So there was, we've leveraged a contract through the provincial government where we did a cost benefit analysis between lease versus buy. And we're in the process of starting, I think, over a period of 3 to 4 years of switching that all over. So this would be reflective of the first year of that lease. So it must be early last year if we've got that significant a change. I'm just trying at a loss of exactly when we got that approved. It seems like yesterday, but I know it's longer than that.
Okay. Just a couple comments, if I might, from the chair. One, I appreciated the sort of the preamble report. I think it gave us a really good overview and provided the context for the statements. Once again, 40 years of AAA is a good thing. Like Councillor Van Holst, I always somehow turn to that debt per household figure, which, with the exception, I believe, of 2011, when we did some things related to economic stimulus coming out of the recession and made some significant investments, it's been a consistently decreasing on a household per capita basis number, which I think is a positive thing. The reserves, it's funny when I listen to the commentary around reserves. Yes, it's to what end? The why of the reserves is almost, well, is as important, if not more important, than the amount. So it's looking qualitatively behind that to say, to what end are we doing this, and why, and what risk? I think Councillor Turner, you mentioned that. So I think that's something to constantly keep track of. Now, there's 3 areas of controls that are noted as requiring some attention in payroll particularly. And I think I'd be looking, I know that that's sitting over in the HR department and Ms. Kovacs is here. Not to get into too much of a fine point on it, I think what I'd just like to see us resolve these issues. Like they're not material, you know, these are just, from a materiality point of view, I always kind of laugh at that number because it's pretty large. But it does say that we have some process inefficiencies that we need to deal with. And I know we've got a payroll department that's over in another department, over in finance. We have a payroll department over in HR. And I know there's, you know, who's on first and what's on second and all that sort of stuff happens, but we need to work efficiency. And I think there is something on the internal audit plan, and that we'll be looking at some of those processes. And I think so before we have this conversation next year, I'd like to see us have some improvements in that particular area. And I know there's issues around confidentiality and all of those sorts of things, but I don't know if we need a motion on that. But I would be looking to Mr. Hayward and Ms. Barbone to resolve some of those process issues, because this is just an area, I mean, and plus with the automation and all of those sorts of things, we just want to get better at it and more efficient at it. So that would be my comment on particularly those three areas, and making sure that we have the appropriate controls. Mr. Hayward, I'll just ask you the question, do you need a motion from this committee on that? Or is it a foregone conclusion that it's highlighted here and it'll be dealt with?
Through the chair, it's highlighted there. We will deal with it. Internal controls are responsibility of management, and we want to make sure we have the appropriate controls in place so we don't end up with a qualified opinion down the road.
If there's no other comment, I'll call, okay, Councillor Helmer.
Yeah, some comments based on the summary page of the 5-year review. I think that's a very helpful page in the overall report. And I think I said some of these things last year. I don't want to sound like a broken record, but they are, I think, quite important. And I'm just looking at the current year versus 2005. You know, 2005 is sort of like a base year where if we come from over the last little while, the total long-term debt associated to general municipal rates is down. This is in nominal dollars. This is even deflated. Down almost 18% compared to 2005. It was a huge decrease, frankly, in the amount of debt. And overall, as Councillor Turner pointed out, even including the water rate supported debt, it's still down almost 11% over that period. And that's in nominal dollars. We're paying 38% less on an annual basis in interest payments, partly because we were borrowing a little bit less money, but partly because interest rates are so much better than they were in 2005. 38% less in interest payments, that's a huge amount. Again, that's in total dollars, like that's nominal. It's not been deflated. Our reserve funds, as Councillor Turner was pointing out, are up 252% over what they were in 2005, which is just a humongous change, right? From 200 million to 800 something million. It's a huge increase. And I think we have to think about these bigger picture changes as we're dealing with, especially our next multi-year budget. There are some, I'm glad to hear, for example, that we're talking about targets for the various reserve funds, because I think we need to have those. Partly because I think you can become overly aggressive on the saving in advance. It seems very financially prudent to save in advance, but you know how we finance things either through debt or through reserve funds is an issue around intergenerational equity. You know, who is going to pay for what services and who's benefiting from those services. So I think we need to make sure that we're being very consistent across the organization in how we approach that. Some organizations, for example, the Lake Huron Water Board, are very, very aggressive in their plans to save with reserves in advance for something they're going to build 30 or 40 years down the road. And that is outside of the current ratepayers' horizon for most of the ratepayers. They're just not going to benefit from that. They won't be alive, a lot of them, to benefit from anything like that. So I think we need to note those kind of big picture trends certainly the, decreased reliance on debt, lowering interest payment, all those things are very good. But the significant increased reserve funds, I think that's something we have to keep our eye on, especially as we're sort of saying who is going to pay for these things over time, and what's the appropriate way to be paying for these future things, especially on the capital infrastructure side. So those are my comments on the statements. Obviously, the statements are great. We only have a couple of comments from the auditors on a humongous enterprise across all kinds of different services. I think that's remarkable and should go without saying that that's a very good result. Not quite as good as the result at the health unit where we had no corrections at all, but very good. And I think it's a testament to the team in finance, but also like throughout the whole organization that people are doing things very well.
Thank you. I'd just like to, a quick question and a comment as well, since we were talking about the reserve fund for the city. I'm curious to know if it is required through all our boards and commissions that they have a reserve fund, or is it strictly done through each board and commission making that decision?
Through the chair, not all the boards and commissions are the same. There are, the police, there's a couple that have their own, but the majority are held by the city, which is in line with our surplus deficit policy in terms of how we flow things out, whether they maintain it and it comes back to the city or not. So it is different for each board and commission.
Thank you for that. And I just want to thank you to staff and for all the work that you've done. Keeping that AAA obviously is congrats. And I think it's really appreciated getting the particulars and the updates every year. I think it's something that is important that we understand where we are at the city and how we move forward. And I think it was very clear and concise, and just want to acknowledge all the work that staff does, and thank you.
Mr. Van Holst.
Thank you very much. And I want to thank Councillor Helmer for his comments too. Just about the reserve funds, and of course we made quite a bit of investment here. And when we do those things aggressively, then there's other things that we of course can't do aggressively, and there's things in our strategic plan that we might be able to be attacking with more vigor. And of course that's a council decision, but certainly something that that we around the horseshoe have to decide on is really what are those priorities. And I don't know if that's something we've done with that consciously, where we compare one priority to the other. We've got a lot of priorities happening and things come up and they all seem important and we do those things. But as far as deciding how we balance all those things, that I think it deserves a little more work on our part. So, but as far as staff goes, thank you very much for all of this work. It's once again a great deal that's been done.
Through you, Mr. Chair, yes, the issue of priorities and where we're going in the future, obviously we've got the strategic plan, we have the multi-year budget, and those all tie into where do you want to spend your money, what's the priorities that you have to spend. And I would agree, we probably need to spend some time dealing with those issues and making sure that we're honing in on the areas that council really wants us to hone into. One of the things with reserve funds, especially when you're looking at this number, it's a big number, but you've got to remember it's a cash basis. The commitments aren't against it. It's also consolidated. So when you get the LTC, for example, they got some reserve funds that are reflected in here, and yet you wouldn't necessarily see them through the budget process because you're just looking at the net amount. So I just want you to be cautious of that as well. This is a big number, yes. What you really need to look at is on the budget and the budget projections, where are we going out? And what are those different categories that we got? We try to categorize them, as Ms. Baban indicated as well. We are trying to put the targets on them, and she's definitely pushing that work very, very hard. You also have your financing strategies that you have in place. What is going to be pay-as-you-go? What is going to be reserve fund funded? We've never said debt is bad. All debt is bad, but again, coming back to Councillor Helmer's point about the intergenerational equity, that's very important as well. So really, the discussion on where you're going, that's where the budget hits this, and that's why we try and do the translation from the budget view to the financial statement view because it is different and the numbers are very different because of the consolidation and different way of looking at it. Also, just want to take the opportunity, if I may, to thank Ms. Barbon because I think she's done a phenomenal job in pulling all this together, and it's been a difficult time and difficult year end given the changes that have gone on in the organization. So just want to recognize her as well.
Well done. I'm going to call the question. All in favor? Any opposed? Thank you. And on this, not just Ms. Barbone, certainly, but to the team as a whole. Wave, Sharon. Always steady and in the back as well. Just, you know, as a non-accountant, you know, knowing that your numbers are your numbers is so important, and it allows you to be secure in making the decisions that you're making, and this is a really good audit, so thank you very much. We have one other item of business. It's a non-financial item of business, but we do have an audit of the downtown closed circuit TV. And thanks for coming, Julie. You don't get to see you here very often.
We're going to fix those big problems. You won't be seeing me next time.
What did she say?
You won't see her next year.
Oh, is she going to retire?
No, she's going to fix the problem.
Tell Julie that she's always welcome to come, problem or no problem. Okay, on this report, is it simply a receipt? You did the audit, is that correct, Katie? Is there anything we need to be aware of here? Let me just ask it that way.
Sure, through you, Mr. Chair. This is our final, the results of our specified auditing procedures over the CCTV program. So the report has been reviewed with management and has been finalized. So my understanding is it comes to this committee for information, and happy to take questions if there are any.
Any questions? Yes.
The only question I have is, I know we get these reports every so often, and they're it's that specific year. Is there any long view we can have just to see what it has looked like over the past several years? Just because we always note that there are a couple of instances where something, you know, was missing, et cetera. So just so we can put with the current report in context. So nothing we need today, but just something maybe to consider for the future.
Anything further on that? No? So, okay. Councillor Hopkins?
I was just seconding.
Okay. I just was looking to see if Martin had something else. Were you coming back with us, or did you have something to add to this one? No, okay. Okay, moved, seconded, all in favor? Thank you very much. Motion to adjourn. Councillor Turner, Mr. Goulart, all in favor? Debate, objections? Thank you very much. I think we're back in the fall. If I don't see you, have a great summer. And for those of you who are on council, see you next week.